Okay, hi. So today's lecture will be on standard costing and variance analysis. Okay, so this has got something to do with the flex budget, which we talked about previously. So when you flex a budget, we are actually calculating or recalculating the budgeted figures uh, and comparing it with the actual figures based on the same level of output, right? So the keyword here is same level of output. So in this chapter, we're going to do something similar to that. So, but before that, a standard cost is a predetermined cost, right? Which we calculate before we start making the product. Okay. So basically, standard costing is all about the process of after budgeting. See, initially we budget, right? We plan what's going to happen in the next few years. So in the next year. So every month in the next year, month by month, we will review back whether how far has the actual figures deviated from the planned figures. So this is where standard costing comes in. Standard costing, uh, we are capturing the difference between the flex budget and the actual amount, right? So when we flex the budget, the amounts are adjusted as though the budgeted figures are based on the same actual quantity as the actual cost, right? So main purpose of standard costing is to improve, it is a means of cost control, and it can tell us where we have overspent or underspent. Okay. So standard costing can lead to better decision making by the management, because when we know we have overspent, then we would list down the reasons for it and try to control the cost. Okay. So the advantages of standard costing is it enables us to plan and control, because once we have detected where the actual cost differs from the standard cost, then we will know where we have underspent or overspent. So standard cost, you can take it as what the cost is supposed to be. Actual cost is what the actual cost actually was. So for example, if the direct material cost was supposed to be $5,000 and the actual material cost is 5,100. So that means we have overspent by 100. So we need to look back into the reasons as to why we have overspent and improvise from there. Okay, so these are the advantages in setting up, these are the advantages of setting standards. Okay, it helps in planning, it helps in controlling the cost, it helps to, um, what do you call, to make reports. Okay, and it also helps speed up the reporting, because by working out standard cost, we can actually get to the reason as to why the actual cost differs from the standard cost. Okay, now there are also some problems in setting standards, because in an organization, when we set standards, some of the employees are going to resist. Okay, that means the standard set might be too high. So this will lead to behavioral problems, as in the employees do not want to cooperate. All right. Okay, and also in the process of setting standards, there could be some errors in forecasting. Okay. This section deals with the limitations of standard costing. So, standard costing, for it to work, the figures must be valid. That means we will need to review the standards from time to time to see whether the standards are applicable or relevant to current times. Okay, and limitation of standard costing. Another one is the available of data. Okay, so if insufficient data is available, then we will not be able to carry out standard costing. Okay, and then the process to which it is applied. So the task of setting and maintaining standard is justified only when operations are conducted on a repetitive basis. Okay, so usually standard costing is more applicable for mass production of goods, and obviously in the manufacturing sector. Okay. So the standard cost card, what is a standard cost? This is an example of a standard cost card. A standard cost card basically shows us the expected cost of producing 1 unit of the product. Okay, you can think of it like a recipe to do the product. See? Okay, so before actually manufacturing the products, normally companies they will set up a standard cost card so that they can refer to the standard cost card and use this as a means to produce. So for example, in this standard cost card, it says that to produce 1 unit of this product, it requires 2 types of raw material, material X, say. X and Y are just names of the raw material. So let's say material X, we need 3 kilograms to make 1 unit of this product. So we need to put in 3 kilograms of material X. And the standard cost is $4 per kilogram. So this price per kilogram may differ because standard is what we plan. And in the future, usually things go against our plan. For example, while preparing the standard, we would have checked with suppliers and they would have told us, okay, they will charge us $4 per kg. But come future, sometimes the unexpected happens. Like probably maybe there was a sudden uh, change in the worldwide demand, sorry, the worldwide supply of material. So that will cause the price to alter. So supplier cannot charge us $4 anymore. We might have to pay more to buy this, right? So all these calculations will be reflected in standard costing. Okay. Okay. In this chapter, it's called standard costing and variance analysis. So the word variance means to be different, right? So we are going to do variance analysis for the different types of costs, which means we are going to compare the expected cost with the actual cost. Okay. Now, when the figures are different, we calculate the difference and we also have to state whether the difference is a favorable or adverse difference. So favorable means it's a good difference. Adverse means it's like a bad difference. For example, if the expected cost is say $10 and the actual cost is lesser than that, say $9. So this means we have saved $1. So the difference is $1, but you don't just write one, you write $1 followed by the word favorable. Yeah. Okay, because it's a good difference, because cost should be minimized. So when your actual cost is lower than what it's supposed to be, that's good news. So it's favorable. See, on the other hand, if the standard cost is supposed to be $10 and the actual cost is higher than that, say $12, that means we have overspent by $2. So your answer would be $2 adverse. So make sure you write the word favorable or adverse as appropriate, not just the figure, not just the difference. Okay, okay, now let's start with direct material. Now, basically what I'm doing is I'm analyzing the cost, okay? And if you remember from your AS work, the basic cost elements of a product is direct material. Then we have direct labor, right? Then we have direct expenses. And then we have the OA. So I'm going in line with this, okay? But usually this chapter does not talk about direct expense. So mainly we're going to be looking at direct material variance, direct labor variance, and overhead variance. So I'll start off with direct material variance. Okay, here's the idea. So direct material costs consists of units as in kg. See, direct material can be expressed in many ways. You can express it in terms of kilogram, in terms of gram, in terms of liter. So all that quantity, so I'll refer to them as quantity. So quantity could either mean kilograms or grams or liter or so on. So quantity times price per quantity. Okay. So basically in a mind map, we are here. Okay. So now for the direct material standard cost and actual cost to be different, that difference must have either come because of the quantity effect or because of the price effect. So which means I'm going to break the cost into two components. I'm talking about direct material cost. I'm going to break it up into two components, which is price and usage. Okay, we're going to calculate the price variance and the usage variance. Okay, so these are the formulas. So in this chapter, you have formulas which you have to memorize because formula sheets are not given during the exam. Okay, so we start off with direct material. So direct material cost. Standard cost of direct material is made up of two components, as I mentioned just now, price and quantity, because price multiply quantity gives you the direct material cost. So now we're going to learn how to calculate the price variance. Okay, so price variance is that portion of the direct material cost variance which is different between the standard price and the actual price. So this is the formula. Direct material price variance equal standard price minus actual price times actual quantity bought, actual quantity purchased. Okay, so whereas the usage variance is the difference due to quantity. That means how much quantity we were supposed to be using against how much quantity that we actually used. Okay, so therefore, the formula for direct material usage variance is standard quantity minus actual quantity times standard price. Okay, so whereas price variance was how much was the price per kg that we were supposed to pay and how much we actually paid. So usually the price variance is due to the difference in the price, which is usually an external factor because the organization cannot control price. Price is something which is controlled by external forces, based on demand and supply out there, as you learn in economics. So price variance is usually more of an external factor, but usage variance is more of an internal factor. That means, sometimes when you, in the process of carrying out the task of making the product, workers would have made a mistake. So when they make a mistake, they probably need to redo. So they use up more quantity than they actually need to. All right. Okay. So now let's be concerned about the calculation bit. So here's an example, a short example on how to calculate the price variance, usage variance, and the cost variance. Okay, so actual purchase of material, 5,100 kilograms at 99 cents. So this is what actually happened. We actually purchased 5,100 kilograms of material X at 99 cents per kg. Okay, actual output is 2,500 units. So this is the finished goods. Okay, kilogram of material used is 5,100. So which means we used up all the quantity that we purchased. We purchased 5,100 kg and we used 5,100 kg, right? Now, so this is what actually happened. What I'm coloring in red is what actually happened. Now, the standard says that 1 kilogram of material X should, sorry, to make 1 unit of the product, we are supposed to use 2 kilograms of material X. Okay, and the standard cost is $1 per kg. That means in the planning stage, we established that to make 1 unit of the finished goods, we are supposed to insert 2 kilograms of material, and the price per kg, as we agreed with our supplier, is $1. So therefore, the standard material cost per unit is 2 times 1, which is 2. Okay, now we're going to calculate the material price variance. So how do we do this? So the form, we are calculating direct material price variance. So the formula is standard price minus actual price times actual quantity purchase. Okay, so the standard price is $1. When you say standard price, it means price per kg. Okay, $1. The actual price is 99 cents per kg. Can you see the actual price is lower than the standard price? That means we expected to pay $1 per kg, but we ended up getting at a cheaper price. Okay, so I think the formula is standard price minus actual price is 0.01. So you need to now times actual quantity. So actual quantity means the actual quantity purchase, which is 5,100. Okay, 5,100. So when you multiply 0.01 with 5,100, you're going to get $51. Now, since the actual purchase price was lower than the expected purchase price, we save 1 cent per kilogram. Okay, so that's a good difference. Hence, you must write here favorable. $51 favorable. Okay, so the direct material price variance is $51 favorable. Okay, now let's calculate the direct material usage variance. So direct material usage variance, the formula is standard quantity minus actual quantity times standard price. Okay, now standard quantity means how much quantity of how many kilos of material we are supposed to be using to make 2,500 units, 2,520 units of finished goods. So the standard says 1 unit we should use 2 kilograms. So if you follow the plan, to make 2,520 units, we should be using 2 times 2,520 kilograms. So which means the standard quantity is 2 times 2,520. So we should be using 5,040 kilograms. But the actual kilograms used was more than that, 5,100. So we overused, which means we might have had to repeat the work or something like that. We used more than what we're supposed to use. So how many kilograms extra did we use? We used 60 kilograms extra. So when you multiply by standard price, okay, the standard price as we found earlier was $1, right? The standard price is 1. So therefore, the answer is going to be 60 times 1. Okay, so the answer is $60. Now, is this favorable or is this adverse? Is it a good difference or bad difference? We check here. We were supposed to be using 5,040 kilograms, but we used 5,100 kilograms more. So this is a bad difference. So we need to call it adverse. Okay. If it's a good difference, we call it favorable. If it's a bad difference, adverse. Okay. So now, to answer the third question, material cost variance, direct material cost variance, we have to sum up both of these. Okay, so to sum up both of these, Okay, direct material price variance was 51 favorable, whereas the direct material usage variance was 60 adverse. Now, when you combine these two, because you have two, one is favorable, one's adverse, just like debit and credit. So when it's different, as in one favorable, one adverse, you need to minus. Just like in maths. For example, if it's negative 51 plus 60, okay, you take the difference, right? So the same thing goes. So the adverse is 60, the favorable is 51. So the adverse amount exceeded the favorable amount by $9. So since adverse is more than favorable, so it's $9 adverse. So you write the more dominant one. Okay. So, but for example, if you're adding if both are favorable, then you add. Or if both is adverse, then you add. But if you have one favorable, one adverse, then you need to subtract, and the bigger amount is the dominant one. Okay. So direct material cost variance is $9 adverse. Now we can check our answer in another way. The standard direct material cost should be $2 per unit multiply 2,520. 2 multiply 2,520. Okay, so which will give us an answer of $5,040. But the actual direct material cost was 5,100 times 0.99, which will give us 5,049. So we're supposed to spend 5,040 on material cost, but we spent 5,049. So can you see here? We have overspent by $9. So that's how I get the $9 difference. So which means in standard costing, you don't just look at the difference in cost, but you need to go further. You need to break up the cost into both its component, and then combine both the component, and you should get back the cost variance. Okay. Right. So now moving to direct labor variance. So direct labor is a result of multiplying the rate per hour with the number of hours worked. So the difference in the rate is what we call rate variance, and the difference in the number of hours is called the efficiency variance. So which means what I'm trying to tell you is the rate variance is caused by the difference in labor rate, what we plan to pay and what we actually pay. Okay, so this difference in labor rate can be higher or lower than the plan rate due to reasons happening after the planning stage. For example, if you plan to, while at the budgeting stage, if you plan to pay labor $10 per hour, but after that, during the actual stage, when we wanted to employ labor, let's say there was shortage of labor in the market. So when there's less of supply in the market, the labor rate will push up. So we might have had to employ labor at more than $10 per hour. On the other hand, if there was oversupply of labor in the market, then we would have got better rate. Maybe laborers are willing to work for $9 per hour, for example. Yeah. Okay. So the rate variance is more of an external factor. Okay. But efficiency variance is about how much time the labor was supposed to take to do the job, to make the production, to produce the units, and how much time they actually took. Okay. So the labor rate variance formula is standard rate minus actual rate times actual hours. The direct labor efficiency variance formula is standard hours minus actual hours times standard rate. Okay, so standard hours is how much time they were supposed to take, and actual hours is how much time they actually took. So now let's look at an example on to calculate labor rate. Okay, so using the information below, calculate the labor cost variances. So you have direct wages per unit cost $3 and $2 per hour. So this line tells you the standard, what it was supposed to be. Okay, because they didn't use the word actual there. And then the next line, you see the word actual. So actual output produced is 4,000 units, and labor actually worked for 11,750 hours, and the labor cost was actually 24675. So we notice here the actual direct labor rate is not given, but we can calculate. All we need to do is divide this with this, and you get the actual rate. Okay, let's get down to the calculation. So I'm going to do the same as what I did here. So let's calculate the direct labor rate variance. So the formula is standard rate minus actual rate times actual hours. Okay, so the standard rate means the standard rate per hour. So that's $2. So standard rate is $2. Now the actual rate per hour, that is 24675 divide 11750. So 24675 divide 11750, which will give us an answer of $2.10. You see, we were supposed to pay $2 per hour, but we ended up paying $2.10 per hour. So we are paying extra 10 cents per hour. So that means from here, you know it's going to be an adverse variant because we are paying more than what we're supposed to pay. Okay? So standard rate, so what you see in the bracket, SR minus AR is 0.1. So now we need to multiply by actual hours. So go back to the question. Labor actually worked for 11,750 hours. So 0.1 multiply 11,750 will give us an answer of 1175. But remember, as I told you, you don't just put the difference, but you need to write here favorable or adverse, whichever is appropriate. So since the actual rate is higher than the standard rate, it's more cost first. So this is adverse variance. Okay, so the direct labor rate variance is 1,175 adverse. Okay, now let's work out the direct labor efficiency variance. So the formula is standard hours, how much time labor is supposed to take to do the job, minus actual hours, how much time they actually took, multiply standard rate. So standard hours, okay, to capture standard hours, okay, if you follow this standard, 1 unit is supposed to take, labor is supposed to take 3 hours. So to produce 4,000 units, they're supposed to finish the job in 12,000 hours. Okay, so standard rate is 3 times 4,000, which gives us 12,000 standard hours, sorry. Okay, so actual hours, they actually took lesser than 12,000. They took 11,750 hours. So which means labor saved time. Okay, they saved 250 hours. So now you need to multiply by the standard rate, but then standard rate, we have it here already. You don't need to search anymore. So multiply by 2. So the answer would be $500 favorable because labor was more efficient. When they work lesser hours than they should, we pay them less. Our cost, labor cost is lesser. Okay. Okay. Before I go on any further, when you write the formula for material and labor, it doesn't matter whether you write it as standard price minus actual price. It doesn't matter whether you write as standard minus actual or actual minus standard. So here we ignore the negative, we just take the difference only. So you can remember this formula as actual price minus standard price or actual quantity minus, because we're only seeing the difference. Okay, so you ignore the negative and all that. You're only taking the difference. That's very important, yeah? Please take note. Okay, so then the direct labor cost variance can now be calculated. It is the standard direct labor cost minus actual direct labor cost. Yeah, I could have otherwise written this as actual direct labor cost minus standard. Like I said, doesn't matter how you write it, it's just the difference that we want to capture. So the standard direct material cost, I mean the direct labor cost variance is you need to combine these two variants. So direct labor rate variance 1175 adverse, and then you have direct labor efficiency variance 500 favorable. So when you combine these two, you see one is adverse, one is favorable. So it's different, what do you call, I will use the word sign, like different sign, right? One is adverse, one is favorable. So when it's different, you need to subtract. So 1175 minus 500. So the answer is 675 adverse, because adverse is more dominant than favorable. Okay, so we could have done this in another way. You can check this in another way. If you take the difference between standard labor cost and actual labor cost, we are going to get this. So standard labor cost would be per unit $6 times 4,000 units. So 6 times 4,000 is $24,000, right? 6 times 4,000 minus actual direct labor cost is 24,675. So as you can see, the difference is 675, and because the actual cost is higher than the standard cost, we end up paying more than we should, so it's adverse. Okay. Okay, now we come to sales value variance. So this is the only variance where we deal with revenue. The other variances are all costs. Okay. So for cost, if the actual was more than the standard, that's adverse. But for revenue, if the actual is more than the standard, then it's favorable, because we always want to maximize revenue and minimize costs. So sales value variance is the difference between the budgeted sales and actual sales. Okay, so breaking the sales value variance into both its components, we have the sales price variance, because to get sales is price times quantity, right? So we have the sales price variance. This is the formula. Standard price minus actual price times actual quantity sold. Okay, and then we have the sales volume variance. Volume here means quantity. Okay, so standard quantity, how much we plan to sell, minus actual quantity, how much we actually sold, times standard price. Okay, now you need to be very careful with volume, because there's two formulas for volume, one of which I just talked about, and one is called sales margin volume variance. So of late, most of the exam questions tend to ask you this, and very, very less of this. So sales margin volume variance, this is the formula. Standard profit per unit, okay, times budgeted quantity minus actual quantity. So to get standard profit per unit, it's standard selling price minus total standard cost, which I will demonstrate in a question later. Okay. So now the volume formula which I'm showing you now is for this one, not the margin. The margin volume variance I will show you in a question later. Okay, let's work this out. So budgeted sales is 1,000 units. That means we plan to sell 1,000 units and we plan to charge selling price of $10. So therefore, our planned sales or budgeted sales is 10,000. But in actual reality, this is what happened. We sold just 900 units instead of 1,000, and our actual price was more than what we're supposed to charge. So this is our actual sales. Okay, so calculate the following, calculate the sales value variance. Okay, so sales value variance means you compare these two figures. So therefore, the sales value variance would be 10,800 minus 10,000. So as you can see, the actual sales was higher than the planned sales by 800. And it's good because our sales turned out to be more than what we thought it will be. So it's a good difference. So favorable. Okay. Okay, now we're going to calculate B and C. And when we combine B and C, we should get back this answer, 800 favorable, if you have done it correctly. So when you combine the sub-variances, you will get back the main variance in any variance that you calculated. Same for material and labor just now. Okay, so sales price variance. So sales price variance is standard selling price minus actual selling price times actual quantity sold. So the standard selling price per unit is $10. Actual was $12. So standard price and actual price 12. Remember, I'm ignoring the negative one, so the difference is 2. So I know, see, since I managed to sell the product at a higher price than I thought I could, so I know the answer is going to be favorable. Okay, so now I'll multiply by actual quantity sold, which is 900. So multiplying 2 with 900 will give me 1,800 favorable. Okay, now I'm going to calculate sales volume variance. So sales volume variance is the difference between standard quantity. Let me put the formula here. Standard quantity minus actual quantity times standard selling price. Okay, standard quantity is how much quantity we plan to sell, which is 1,000. This is actual quantity. So 1,000 900. So the difference is 100. So now I need to multiply my standard selling price, which is $10. And I will get an answer of 1,000. And the answer would be adverse. Why? Because I ended up selling lesser quantity than I thought I could. So when I combine these two, see, because one is favorable, one is adverse, so I need to subtract. And there's more amount in favorable and adverse. So the difference is, see, I come back to 800 favorable. Okay, so combine these two, you'll get 800. So we subtract when one is favorable, one's adverse. We add when both are favorable or both are adverse. Okay, so now we come to the variable overhead variances. So the overhead variances, I will explain the figure, and then once and for all, we'll do a question. So variable overhead variance. Okay, we have variable overhead expenditure variance. This is the formula. Actual rate minus standard rate times actual hours. So this is the difference in variable overhead rates that we pay. Okay, the actual rate against the standard rate. Okay, efficiency variance. This is a formula. Actual hours minus standard hours times standard rate. Okay, so as always, when you combine these two variances, you will get the variable overhead cost variance, as I've mentioned here. Okay, okay, for fixed overheads, okay, you need to remember these formulas. Fixed overhead expenditure variance, the formula is actual expenditure minus budgeted expenditure. So fixed overhead is fixed whether we produce units or not. So we need to maximize the usage of this fixed cost. Okay. So when we spend more on fixed overhead as compared to what we plan to spend, then it will be adverse. Okay. So the actual expenditure is more than the budgeted expenditure, then it's bad. We have overspent. So it will be adverse. On the other hand, if the actual expenditure is lesser than the budgeted expenditure, then that's good. It will be favorable. Okay. So then we have fixed overhead volume variance. Okay, this is a formula. Budgeted hours minus standard hours times fixed overhead absorption rate. Okay, so this budgeted hours is how many hours we worked on using the fixed overheads, right? So if standard hours is more than budgeted hours, then it's favorable because we're getting more out of the fixed overhead cost. We're using the fixed overhead constant cost to make more units. It's like we're exploiting more. Okay. Okay. If the standard hours is less than budgeted hours, then it's adverse because we're not using what is there. We're not using it enough. Okay. So then we have just two more formulas. Fixed overhead capacity variance. So this is a formula. Budgeted hours minus actual hours times fixed overhead absorption rate. Okay. So if budgeted hours is less than actual hours, which means if we actually spend more time using the fixed overhead resources, then we should, or then we plan to, it's good because we're exploiting more. Okay. On the other hand, if you don't spend more time than we plan to, then it's adverse. It's adverse when we're not utilizing the fixed overhead to the best that we can. Okay. Okay. And on the other hand, fixed overhead efficiency variance. Okay, how efficient were we in using the fixed overheads to make as many products as we can? So this is where if the actual hours is less than the standard hours, that means if you take more time using the available resource, if we take more time than we should, that means we can make lesser products as we plan to. So it's adverse. Okay, on the other hand, if we took lesser time, right? If standard is more than actual hours, that means we took lesser time. Therefore, we can make more products. So we were more efficient, then it's favorable. Okay, so that is the conclusion. So fixed overhead efficiency variance plus capacity variance is what we get, is what we call volume variance, which means volume variance is broken down into efficiency variance plus capacity variance. Combine these two variants and you'll get the fixed overhead volume variance. So when you combine the volume variance and the expenditure variance, you will get what is called cost variance. Okay, so that is what I showed here in this diagram. This diagram shows the summary of what I just talked about. Material cost variance. If you want to see everything from a nutshell, the material cost variance, labor cost variance, variable overhead cost variance, fixed overhead cost variance, okay, which is broken down into expenditure variance and volume variance. And then volume is broken down into efficiency and capacity variance. Right? So now I will proceed to show you examples of past year questions. Okay, so here is an example of a past year question. So this is May 2018, paper 32, question number 6. Right, so C Limited produces tables. Each table requires the following. So the product is tables. Each unit of table produced requires raw material, 3 meters of wood at $80 per meter. So all these are the standard, the plan figures. Direct labor, 12 hours at $30 per hour. And then fixed production costs, overhead, $10 per direct labor hour. So the fixed production cost is absorbed based on direct labor hour. So the budgeted production is 5,000 tables. Actual production is 4,800 tables. So these are the actual production costs. Okay, and they tell you that all tables produced were sold. So which means that there is no inventory. Okay, part A, state 2 limitations of a standard costing system. So you can try out these answers. Setting of standards is time consuming, costly, right? Standards need to be updated regularly in order to be relevant. Setting too high a standard can be demotivating to staff, right? And setting standards involve prediction, which has an element of uncertainty. So not necessarily that the standards are what do you call achievable, right? Okay, so that's for the theory part. So for the calculation bit, see, normally calculations earn you a lot of marks here. Okay, so calculate the following variances. So direct material price variance. So you need to be careful. When they use the word price, it means price variance, not the cost variance. Cost means they will say cost variance. So direct material price variance. So the formula is standard price minus actual price times actual quantity, right? Standard price minus actual price times standard quantity. So the standard price is $80 per meter. Okay. So here they have worked it out another way, but which will still give you the same answer. I'll work it out the usual way. So standard price is $80. Okay, actual price, which means actual price per meter is 1190,400 divide 15360. So 1190,400 divide 15360, which is $77.50. So then we multiply actual materials purchase, right? So in this case, all tables produced were sold. That means we purchased this much and we also use this much. So times 15,360. So it will give you the same answer as you see in the mark scheme, which is 38,400. And don't forget, you need to write favorable or adverse. So in this case, it's favorable. Okay. So what the mark scheme showed, and my method here may be different, but you just focus on the final answer. Right? So next we calculate the usage variance. So if you calculate the usage variance, the formula is standard quantity minus actual quantity times standard price. So standard quantity means how many meters squared are we supposed to be using to produce 4,800 tables and not 5,000? Because remember, we were flexing the budget from 5,000 to 4,800 units. Remember, the budget figure must always be the same as the actual units. Budgeted units must always be the same as actual. So to make 1 unit, we require 3 meters. So to make 4,800 units, we require 3 times 4,800, which is 14,400. So 14,400 meters. But the actual quantity used was more than 14,400, which is 15,360. So that's bad. It's adverse. So from here, you know your answer is going to be adverse. The standard price is 80. So we'll get an answer of, don't forget to put the dollar sign. We'll get an answer of 76,800 adverse. Okay, same as the answer given. Okay, next we work out the direct labor rate variance. So standard rate minus actual rate times actual hours. So the standard rate is $30 per hour. The actual rate is 1,766,400 divide 55,200. Which is $32 per hour. Times the actual hours is 55,200. So as you can see, the actual rate, we are paying a higher rate than what we thought than what we should pay. Okay, so from there, you know your answer is going to be adverse. So this will give us an answer of 110,400 adverse. Okay. Right, then we work our direct labor efficiency variance. Okay, so the formula is standard hours, as in how much time was supposed to be taken to produce the units minus actual hours, as in how much time was actually taken, okay, times standard rate. So the standard hour would be 1 unit is supposed to take 12 hours. So to produce 4,800 units is 12 times 4,800, which is 57,600 hours. Okay, so but the actual hours taken was less than that, lesser than that, 55,200 hours. So times the standard rate, which is 30, which means labor save time. They were more efficient. So the answer is 72,000 favorable. Okay, then we need to calculate the fixed overhead expenditure variance. So this is where the answer is the budgeted fixed overheads minus actual fixed overhead. So the budgeted fixed overheads is 600,000. So which means the fixed overhead rate is $10 per labor hour, and 1 unit requires 12 hours. So it is 10 times 12. This gives us the fixed overhead cost, budgeted fixed overhead cost per unit times budgeted units, 5,000. Okay, so 120 into 5,000 will give us 600,000. So that's how we got 600,000 here. Whereas the actual fixed overheads is already given by the question. So we just copy it down. Now, since the actual is lesser than the budgeted, so we save 20,400, hence it is favorable. Okay, so fixed overhead volume variance. The volume variance, right, is the difference between, here it is, budgeted hours and standard hours, and times fixed overhead absorption rate. Okay, so the answer is 24,000. Okay, how do we get that? Okay, the budgeted hours is 12 hours per unit times 5,000. So 12 times 5,000. This is the budgeted hours. The standard hours is 12 times 4,800. Okay, then you multiply by the fixed overhead absorption rate per hour, which is $10. So this will give us an answer of $24,000. That's what you see here. So why was it adverse? Because the budgeted hours was more than the standard hour. That means we plan to use more hours, but we did not use as much. Okay, we did not use as much hours as we plan to use. So it's kind of like wasted. So hence adverse. Okay, next, prepare a statement reconciling the budgeted cost of producing 4,800 tables with the actual cost. So this is where you're not new to reconciliation. So we are asked to reconcile the budgeted cost with the actual cost. So therefore, we start with the budgeted cost, 3, 4, 5, 6. So how do we get this? Okay, we need to total up our cost based on producing 5,000 units. So the direct material cost to produce 5,000 units is 3 times 80 times 5,000. So it's 1,200,000. Okay, direct labor will be 12 times 30 times 5,000. That will be 1,800,000. And the fixed production cost will be 10 times 12 times 5,000. Oh, sorry. What this question actually meant here was the standard cost. Okay, standard cost. So which means I need to multiply by 4,800. I remember this question actually, there's a bit of an error in the question. So when you use the word budget, you base on 5,000, but what they actually meant was 4,800. So these figures you need to multiply by 4,800. Okay, since the working is here, so you multiply. So this is the part where 30 times 8. Okay. Okay. 3 times, no, not 30 times 8, sorry, 3 times 80. So 3 times 80 is 240. So you times 400, 4,800 units. Okay, for direct labor, 12 times 30 times 4,800. Okay, and the overheads is 10 times 12 times 4,800. Okay, so the total budgeted or the planned cost is 3,456,000, right? So from this figure to arrive at the actual cost, okay, the actual cost is calculated by just summing up these three figures. Okay, when you total up these three, you will get 1,190, 400 plus 1,766, 400 plus 579. Okay, you will get 3,536, 400. Okay, that's how you got 3,536. So between the standard cost and the actual cost, you put in the variances which cause the difference. All right. So the direct material price variance is, okay, so what we have to do is, if you look up at the direct material price variance, it was favorable. So all the favorable variances, you have to minus. You know why? Because when the cost is favorable, when the variance is favorable, it means that the actual cost is lesser than the standard cost. So this should be standard, not budgeted. Okay. So since we are starting with standard cost, which is higher than the actual cost, so all the favorable variances we have to minus. So these are favorable, these are favorable. Whereas all the adverse variances you have to add. So 1, 2, 3, 4, 5, 6 came from here. Okay. So all the favorable variances we minus, all the actual variances we add, and we'll arrive at this figure. Okay. Okay, additional info. So directors are considering using higher quality wood and increasing the selling price. So advise the directors whether or not they should make these changes. Justify your answer. So this is a 3-mark question. Okay, so 1 mark for decision with comment. So the balance 2 marks One, you need to advise. That means you need to speak for and against. Okay. So using higher quality wood means we have to incur more cost. Increasing selling price, yes, we will get more profit, but we need to be able to justify the selling price to convince customers to yes. So we need to convince customers. So this can be your answers. So you can talk about increasing selling price. You may lose existing customers. Okay. But at the same time, when you increase selling price, that means your product comes with higher quality of goods. So you may gain new customers who are actually looking, they don't mind paying higher price, but for higher quality good, higher quality products. Okay. Ah, so these are all your possible answers. Okay, and then don't forget 1 mark with decision. All right. So that's all for this chapter. Thank you.